Okay, let's just look at the board. Because if you were watching the markets over the last, say, 48 hours, that window of February 3rd and 4th, 2026, you probably felt a bit of vertigo.
Oh, absolutely. I mean, we've spent years, literal years, hearing the digital gold
It's
thesis.
the elevator pitch, right? When the world catches fire, when the tanks roll, you buy Bitcoin. You opt out of the chaos.
It's the foundational narrative. It's why so many people put the asset in their portfolio to begin with, the ultimate hedge against, geopolitical messiness. The idea is it's non-sovereign, so it shouldn't care what governments are doing.
Exactly. And yet here we are. We just saw a massive kinetic military event in the Middle East with the U.S. carrier strike group involved.
Yeah,
And gold. Gold did exactly what you'd expect. It just skyrocketed.
it did.
And Bitcoin. It didn't just stumble. It fell off a cliff. So the mission for this deep dive is to answer a really uncomfortable question. Is the digital gold narrative dead, or was this just a glitch in the matrix?
That is the multi-billion-dollar question, isn't it? And to answer it, we really have to parse through the Bitcoin intelligence briefing for this window. And the shift in tone is, well, it's violent.
How so?
Earlier in the week, it was all about that U.S.-India trade deal. Very optimistic, very growth-focused. And now,
Yeah.
the sentiment indicator is just flashing extreme fear.
Okay, so let's break this down. I think we can look at it in three layers. First, that trigger event in the Arabian Sea, what actually happened and why Wall Street panicked.
Right, the trigger.
Second, the institutional U-turn.
Mm.
I really want to dig into why firms like Fidelity were selling while BlackRock was actually buying.
It's a great bifurcation.
Yeah. And finally, the adults in the room. Because while the price was crashing, the actual regulatory plumbing in places like Canada and some corporate strategies just got a whole lot more serious.
It's a classic split screen moment. You have price on one side and structure on the other. But you're right, we have to start with the trigger. You can't understand the reaction without it. This wasn't a rumor.
No, this was steel in the air. Let's go there, the kinetic trigger. February 3rd, the USS Abraham Lincoln is on station. What are the sources telling us?
So at roughly 10:10 a.m. Eastern, an F-35C Lightning II, that's the carrier version of the stealth fighter, launches from the deck. It intercepts an Iranian Shahed 139 drone over the Arabian Sea.
Okay, and that happens all the time, right? It's usually just a dance.
Usually, yes. It's posturing. They escort each other. They wave. They go home. I see you. You see me.
Standard stuff.
But not this time. The Navy said the drone made aggressive maneuvers. It approached the carrier group, ignored warnings. The intent was unclear. So the F-35C didn't just escort it.
It engaged.
It engaged and destroyed it.
That is a huge escalation. You're using a $100 million stealth fighter to kinetically remove a drone. That completely changes the calculus. And wasn't there another incident that day?
Yes, it felt like a coordinated pressure test. Same day, the MV Stena Imperative, a U.S.-flagged tanker, was harassed by IRGC fast boats in the Strait of Hormuz. The USS McFall had to call in F-16s to get them to back off.
So you stack a shoot down and a near seizure of a U.S. tanker. The algorithms are just going to read that as one word: war.
Or the prelude to it, yeah. And when the algos read war, the war risk premium kicks in. You saw oil spike immediately. Brent and WTI were up about 2%. That's textbook.
And gold?
Gold behaved perfectly. Surged 6.2%, reclaiming 49.30. Silver went even harder, up 9%. That is capital fleeing to safety. It's the classic risk-off trade. You sell the risky stuff, you buy the shiny rocks that have been money for 5,000 years.
But then we look at Bitcoin. And this is where the story just fractures. In that exact same window, while gold is flying, Bitcoin drops 4.5%. It broke that huge psychological floor of 75 grand a wicked down to 72,877. Why? If it's digital gold, why didn't it act like gold?
Because, at least for right now, institutional money does not treat it like gold. They treat it like a high beta tech stock.
High beta. Okay, let's unpack that term. We hear it on financial news all the time, but what does it actually mean for the person listening?
Sure. So in finance, beta just measures how much an asset zigs and zags compared to the whole market. If the S&P 500 moves 1% and your stock moves 3%, that's high beta. It just amplifies the move.
And that's usually tech stocks, AI startups.
Exactly. Things that rely on cheap money and optimism. When the market gets scared, high beta assets are the very first thing you sell because they're seen as the riskiest.
So when the missiles fly, investors aren't thinking store of value. They're thinking, I need to de-risk now.
Precisely. It's what we call a dash for cash. When this kind of tension hits, hedge funds get margin calls on other positions. They need liquidity cash right now to cover those positions or maybe to buy safe, boring treasury bonds.
And Bitcoin has a unique property there.
It trades 2047. It's the most liquid asset in the world on a Sunday, or during a holiday, or like in this case, during a sudden military crisis.
So it becomes the piggy bank you smash because it's the only piggy bank that's open?
That's it, exactly. It wasn't a failed hedge, it was a source of liquidity. They sold Bitcoin because they could, not because they suddenly hated the asset. But for the hardcore hoe dealer who thinks they own apocalypse insurance, well, it turns out you're actually holding a tech stock that trades on weekends.
That is a tough pill to swallow. You think you bought a bunker, but you actually bought a roller coaster. And we can see this playing out in the ETF flows, can't we?
Yeah.
The reversal there was just violent.
Whiplash. I mean, it gave me whiplash just reading the data. On February 2nd, before the drone incident, the spot ETFs took in over $561 million. That was the buy the dip crowd.
Optimism was high.
Very high. And then the F-35 takes the shot. And 24 hours later, February 3rd, that swings to a net outflow of $272 million. That's an $833 million swing in direction in a single day. That is pure panic. That is get me out at any price.
If we break down who was selling, it wasn't everybody, was it? This is where it gets a little more interesting.
No, and this is maybe the most critical insight here. The outflows were primarily from Fidelity and Grayscale. And those platforms, they often represent what we call fast money, independent advisors, momentum traders. When the chart looks bad, they get out. They have a duty to not lose client money, so they trim risk fast.
But BlackRock,
The IBT ticker, they were the only major buyer. They still saw inflows, $60 million on the day of the crash.
wow. That's fascinating. So while everyone else is sprinting for the exits over a drone in the Arabian Sea, BlackRock's clients are basically saying, hey, thanks for the discount.
It suggests a split in the market. The long-term strategic allocators, the people BlackRock talks to, the sovereign wealth funds, the big pension plans, they stayed calm. They see this as noise. A single drone shootdown doesn't change Bitcoin's supply schedule.
But the speculative money ran for the hills.
It fled. And unfortunately, when you lose that passive buying from the ETFs, the spot market has to absorb all that selling. There was just no floor.
And speaking of no floor, we have to talk about the biggest corporate holder. Strategy Inc., formerly MicroStrategy. This week feels like a major stress test for their entire model.
It is. Their shares plunged 8% on this news, but the stock price is just a symptom. The real story is their balance sheet. For the first time this cycle, their treasury is technically underwater.
Okay, define underwater here. Because they hold a ton of Bitcoin, surely they bought some of it way back at like 30K.
They did, but they kept buying. And buying. They hold over 713,000 Bitcoin. But their average cost basis, the weighted average price for that entire stack, is $76,052 per coin.
And the price dropped to nearly $72,800.
Right. So, broadly speaking, every single Bitcoin they own is sitting at an unrealized loss. And you have to remember, the accounting rules changed in 2025. They now use fair value accounting.
Which means they can't hide it.
Correct. In the old days, you only reported a loss if you sold. Now, they have to mark to market every quarter. If the price is down, that loss hits their earnings report directly. It makes their financials look incredibly ugly to a traditional analyst.
And didn't they just buy more right before this crash?
That's the painful irony. Just before the drop, they bought another $75 million worth. But get this, they paid an average of nearly $88,000 for that batch.
Ouch. They literally bought the local top.
It just highlights the risk of their strategy. They're indiscriminate buyers. They don't time the market. But the people buying their stock, the equity investors, they get spooked when they see the company paying $88K for something that's now trading at $72K.
It becomes a leverage trade gone wrong.
Exactly. And leverage cuts both ways. It's great on the way up, but it shreds you on the way down.
Okay, so we've got war risk, ETF outflows, and the biggest corporate holder is underwater. It sounds pretty grim. If we stopped here, everyone would be selling. But, and this is the pivot, you said the adults in the room are busy building. While the price is a mess, the infrastructure is tightening up.
That's the divergence, yeah. If you only look at the price, you miss the structural shift. On the same day, traders were panicking. February 3rd, the Canadian Investment Regulatory Organization, CIO, dropped a massive regulatory update.
The Digital Asset Custody Framework.
Correct. And this is not a suggestion, it's a mandate. Canada has rolled out a strict 4-tier system for anyone holding crypto assets. It's going to completely change who's allowed to hold your money.
Walk us through these tiers, because regulation usually sounds boring, but this sounds Aggressive.
It's an extinction event for the little guys. If you want to be a Tier 1 custodian, meaning you can hold 100% of client assets, you now need $100 million in domestic capital.
100 million. That basically shuts out every startup.
Exactly. All those crypto-native startups with thin balance sheets, they're gone. Or they get demoted. It forces custody toward the big banks and trust companies, the entities that have deep pockets.
What about Tier 2? Is there a middle option?
Tier 2 requires $10 million in capital, but here's the kicker. They mandate external cyber assurance audits.
What do you mean?
It means you can't just tell the regulator, trust me, our security's good.
Oh.
You need an independent, certified auditor to verify your key management, your multi-sig setups, your disaster recovery.
No more trust me, bro custody.
Not in Canada. And here's why this matters for you listening. Canada is often a sandbox for U.S. regulation. Where CRO goes, the SEC often follows. This is the institutionalization of the space. It's painful, but for a pension fund, this is the safety net they need to see before they allocate billions.
It's the gentrification of crypto. It gets safer, but the rent goes way up.
That's a perfect way to put it. The Wild West is over, at least up north.
And speaking of institutions, we saw a big acquisition that kind of flew under the radar with all the war news. Bitwise bought Chorus One.
This connects right back to the ETF story. Bitwise is not satisfied just selling ETFs anymore. They're moving into what's called active yield. Chorus One is a massive European staking provider.
Okay, so for those who don't know, what's the value of staking in this context? Why does an ETF provider care?
Think of it like internet bonds. If you hold Ethereum, you can help secure the network and earn a yield interest, basically paid in more Ethereum. For an ETF provider, that's the holy grail.
Because they can offer an ETF that tracks ETH plus pays a dividend.
Exactly. A 3% or 4% yield, that crushes the competition. But setting it up yourself is technically really hard.
And slow, apparently.
Extremely slow. Right now, if you want to set up a new validator on Ethereum, the queue is over 70 days long.
Wait, seriously, you have to wait 2.5 months just to turn the machine on?
Yep. There's a mechanism called the churn limit to keep the network stable. There are over 4 million ETH just waiting in line to get staked.
So Bitwise buying Chorus One. That's like buying a fast pass at an amusement park.
It's exactly that. They can't wait 70 days. They're buying existing running infrastructure. It shows that the big asset managers aren't worried about this price drop. They're worried about capturing the plumbing of the network. They want to own the rails.
The classic build during the bear market vibe. Okay, let's hit our reality check segment, because there was some humbling news for one of the biggest players in the whole game, Tether.
This is a fascinating peek into the private markets. So Tether, the company behind the USDT stablecoin, wanted to raise capital, and they were floating a valuation of $500 billion.
$500 billion. For a stablecoin issuer, that's bigger than ExxonMobil. That's almost Tesla territory. That's insane.
That's pretty much what the investors thought. They balked. Tether CEO, Paolo Arduino, he tried to position the company as an AI play. He was pointing to their investments in computing, saying, look, we're like OpenAI. We're a tech infrastructure company.
Right, trying to catch that AI hype multiplier. Because if you're a utility, you trade at 10x earnings. If you're AI, you trade at 50x.
And investors pushed back. They said, no, you're a utility. A very, very profitable money market fund on the blockchain. You made $10 billion last year, which is incredible, but you don't have the growth potential of an AI startup.
So what happened with the raise?
Reality set in. They had to slash their expectations. Instead of a $20 billion raise at a $500 billion valuation, reports are saying they're now looking at a much smaller, maybe $5 billion raise. The froth is coming off.
And speaking of reality, there was a very harsh reality check for the darknet this week, the incognito market sentencing.
This was the end of Pharaoh. That was the alias of Rui Shanglin. He ran the incognito market, sold over $100 million in narcotics. He just got 30 years in federal prison.
30 years. And I'm guessing the government didn't let him keep the crypto.
Definitely not. $105 million forfeited. But the real takeaway here isn't the drugs, it's the forensics. Lin used this thing called Incognito Bank, an internal ledger to mask transactions. He thought he was untraceable.
Spoiler alert, he wasn't.
Not at all. The DOJ and the blockchain analytics firms unraveled the whole thing. It's just another reminder that the blockchain is a terrible place to hide. It's a permanent public record.
And now the U.S. government has another $105 million in crypto to sell.
Which, ironically, adds just a little more sell pressure to the market. They're a big whale, and they are not sensitive to price.
Just what we needed. Okay, before we wrap, we have to touch on Washington. Did they finally sign the check to avoid a shutdown?
They did. President Trump signed H.R. 700-148 on February 3rd. The government is funded through September.
Thank goodness, so we're in the clear.
Mostly. For the broader economy, yes. Data reporting resumes, we get our inflation stats, our labor data, the algos can go back to normal, but there's always a catch.
Always a catch.
The Department of Homeland Security is only funded until February 13th.
So we're doing this all over again in 10 days.
For DHS, yes, it's a fight over ICE protocols. They put DHS on a short leash. If they don't agree, we could see a partial shutdown hitting the TSA and FEMA, so that political risk hasn't completely vanished.
So if you're flying on Valentine's Day, maybe get to the airport a little early.
I would definitely recommend that.
Okay, so let's summarize this beast of a 48 hours.
I think to put it mildly, yeah. We have this clear divergence. On one side, you have price and sentiment, and that is crashing. War risk drove a dash for cash, Bitcoin failed the safe haven test, liquidity was sucked out of the ETFs, and Strategy Inc. is underwater. That is the fear side of the equation.
And on the S side?
You have the build side. Canada is raising the bar on custody, basically handing the keys to the banks. Bitwise is acquiring infrastructure. The structural rails of this industry are maturing, and they're maturing fast, even if the price on the screen looks awful.
It's a total split-screen reality. The price is all over the place, but the pipes are getting stronger.
Exactly. And that's usually the signal. When price and fundamentals diverge like this, you have to decide which one is telling the real story.
So here's the question I want to leave you with. We just saw Bitcoin fail this specific safe haven test. When the missiles flew, people sold Bitcoin to buy gold. So does that mean the digital gold narrative is actually dead? Or was this just a temporary liquidity crunch, a panic attack, before it finds its footing again?
And add this to it. Strategy Inc. is now underwater. If this price drop holds, or if things get worse out there, how much pain can a corporate balance sheet really take before the biggest buyer in the room becomes a forced seller?
That is a scary thought to end on. Go check your charts, take a deep breath, and maybe stop looking at the hourly candles. Thanks for listening to The Deep Dive. We'll catch you next time.